This video is going to be a first because I'm attaching a guarantee to it. The guarantee that among the 12 myths that we will dispel today, there will be at least one that you still hold dearly as common sense trading truth and that you keep wrongly applying in your daily trading without thinking twice. So take me up on the offer. You will not be disappointed. So let's get on it. Myth number 1. Diversification lowers risk. How many times have you heard that one? Here's how the good old don't put your eggs in the same basket delusion works. You are told that if you slice your portfolio into sufficiently small positions across sufficiently many sectors, then your portfolio will be less vulnerable in a downturn. At first sight, it makes sense, right? Well, as it turns out, this is mostly wishful thinking. Increasing the number of your positions only does one thing for sure: increase your trading costs. The reality is that risk is barely reduced by spreading your money across instruments that don't have much more than their respective tickers to differentiate them in a market panic. That's right, with some exceptions aside, all stocks tend to fall in unison in a bear market. 2008 or Q1 2020, anyone? You see, what matters is not diversification. What matters is decorrelation. Decorrelation alone achieves risk reduction, and you do not need to be overly diversified to be decorrelated. This can be achieved with much fewer positions as long as they pertain to independent asset classes, actually turning your portfolio in what will seem like a very concentrated one to a novice trader. You see, you need to do what actually works, not what sounds like common sense. Number 2. Good money management is all you need. Now that's a biggie. It is probably one of the most rampant lies in trading forums. Sure, money management is essential. I'm not saying the contrary. But money management is not enough. Put differently, sound money management is a necessary but not a sufficient condition for trading performance. Arbitrarily deciding that you should not allocate more than, say, 2% risk per trade, for example, simply because that is what most people seem to agree on in trading forums, may actually be completely unsuitable, or suboptimal, or downright harmful to your system's risk profile. In particular, no matter how fancy you make it, money management cannot and will not replace a proper statistical edge. It will merely be akin to putting lipstick on a pig. Sure, it can buy the illusion of performance for a while, but eventually, negative expectancy will catch up on you, and the outcome always remains the same: ruin, that is. Invariably, multi-guild systems are the extreme real-life representation of this fact, as shown here. You cannot fake your way into profits, guys. Sooner or later, the market will take it all right back where it belongs. Number 3. The rate of return indicates trading performance. Now, I will not expend too much energy on this one because I have already dedicated an entire course on it. That's how important that piece of trading knowledge is. But the idea is the following. Investors consistently get reeled in by high returns like bees on honey. This whole thing about high returns being equated with high performance is such a widespread myth that I could not pass it in this series. So many people get impressed by returns and then go ahead and decide whether a trader, a fund, or a system is worth a look based on that alone. So let me say it once more. Returns alone provide exactly zero indication of performance. That's right, zero. Not even the beginning of it. What performance is and what you should focus on are risk normalized returns, meaning the amount of return generated per unit of risk taken. Once you realize that, you will realize that returns are a mere function of leverage, and that because they therefore are a choice and not an outcome, they cannot be used as a comparative benchmark to assess trading performance. Number 4. Always trade in the direction of the higher time frame. That's a nice one. The underlying belief here is that you should trade in the direction of the general trend and that essentially trading alongside it will raise profitability at the lower time frame. Once more, that sounds like common sense, right? But then again, so does any myth. The reality, however, is that in most markets, not all markets, but the vast majority of markets, such as Forex for example, there is no edge whatsoever in trading alongside the higher time frame. The reason being that price motions being fractal by nature, all time frames individually follow self-replicating patterns bound by the same formation rules, that is their inherent physics, and are totally segmented between one another and not interrelated in any way. Believing that using a higher time frame bears any kind of informative power over the lower one is therefore necessarily mathematically dead in the water. Number 5. Your reward to risk ratio should always be greater than 1. How many times have you heard that nonsense? The logic, or rather the flawed logic here should I say, is coming from a profound misunderstanding of what expectancy is. Saying that your take profit order should always be greater than your stop loss is the same as assuming that probabilities of win and loss are exactly evenly distributed 50% and 50%, which they are not. The market obviously does an absolutely outstanding job of adjusting probabilities to your different stop loss and take profit sizes. As such, there is nothing that commands you to keep your reward to risk ratio above 1. Your only concern as a trader should be to keep your expectancy greater than 0, and that's it. In fact, you could be perfectly profitable with a reward to risk ratio close to 0, or even a win ratio close to 0%, believe it or not. This game is all about expectancy, meaning combining the size of your gains and losses with their related probabilities. If you're still unsure about what I'm talking about here and what expectancy is, I have made an entire course about it, so make sure you watch it before you place another trade because this is absolutely essential. Number 6. You should be patient to only trade the quote-unquote best setups. Now this one is really boneheaded. Saying that you should wait to trade only the best setups implies that you know which setups are the best, as opposed to a lesser quality one. It therefore implies that you are somehow able to consistently cherry-pick trades and tilt expectancy in your favor. In other words, it implies that you can predict the future of your trades at the incremental level. Can you do that? Of course you can't. Nobody does. Instead of trying to guess what the best setup is, what you should be patient for instead is a setup, meaning the next setup that fits the rules of a pre-established trading system that you have rigorously tested. Trading predictability is possible. Yes, it is, but it does not work incrementally. Instead, it works in the aggregate. It is revealed by the law of large numbers and generates results through your expectancy. But to reach that goal, there is no and there should be no cherry picking involved. Again, what you want to trade is a setup, every single one of them, mechanically, and without trying to second guess or outsmart your system. Number 7. Trading success is 90% mindset. Okay, so if you believe that one, then you should also be able to explain why you don't know of any trading track record provided by a certified psychologist. This is absurd, guys. The truth of the matter here is that trading success has just about nothing to do with your mindset or your subjective approach to it. Trading success is all about knowledge and nothing else. Sure, mindset can break an otherwise knowledgeable trader, but mindset alone cannot and will not make you a trader. Knowledge, however, will give you the assurance that you have an edge over the competition. With knowledge comes the confidence that will allow you to disregard mindset entirely as a component to your success. I already made a video relating how most scams push this notion because of a lack of actual, hard, mathematical and verifiable content to support their narrative. Likewise, you will notice that self-proclaimed traders claiming that mindset is everything have all failed in their endeavor to find a reliable solution to the market riddle. How do you know that? Well, simply because they cannot provide a trading track record to save their lives. So instead, they seek to replace their failure with pseudoscience and avoid grieving the fact that they essentially gave up entirely on doing the hard work and ever becoming a trader. This mindset thing is absolutely grotesque, guys, and you should know better by now. Number 8. Some indicators are obsolete. I had to throw this one in after I came across a forex trading channel that apparently became ultra popular, peddling nonsense that people don't care to check, you know, the usual stuff. So one of the things that this guy states while supposedly helping people build their own system is that they need to combine the quote-unquote right indicators, being careful that some of them have become quote-unquote obsolete. In other words, that they no longer work. I swear I came close to falling off my chair when I heard this BS. This assertion alone highlights a glaring misunderstanding of how markets truly work. I try to keep it within the scope of this video here, but what you need to know is this. No matter which indicator you use, guys, an indicator will only capture one end of the structural motion dynamics that drive financial prices, albeit with some sort of lag, mind you. So do not fall for marketers pushing these sophisticated indicators or trading dashboards, or these pseudo traders insisting that you should find the right combination, picking the special indicators that are supposedly adjusted to work in modern markets, whatever that is. None of these so-called new indicators are reinventing the wheel more than others. Saying that some do is complete nonsense. What you need first and foremost is to understand how price motion dynamics actually work and find a simple and free indicator to capture the side of it that you wish to trade, and that's all you will ever need. And that point allows me to segue into number 9, another widely spread urban legend of trading that most people believe. The fact that apparently markets change. And what's interesting here is that you will especially find this myth to be brought up to explain away why a trading system suddenly stopped working. Let me get this straight. Markets do not change. From a logical standpoint, saying that the market structure changes to a point of rupture of your trading system is like saying that the buoyancy properties of water change over time to a point that will make a ship no longer float over it. Now, how absurd does that sound to make you understand my point? If your trading strategy did indeed stop working, it is because its promising backtest relied on nothing more than a worthless statistical artifact born out of tweaking its parameters over and over and overfitting it to death to your sample's data. The truth is that if your system does not capture a significant portion of true price motion dynamics, it will not stand a chance. It will not be robust enough and you will see it eventually fail. Once again, guys, markets do not change. Volatility only does, and there are more than one way to have your system self-adjust to it. A sound trading system should never break down entirely. It will have periods of underperformance, sure, but it will not fail terminally. So whenever you hear that a system needs some kind of ongoing or periodic so-called re-optimization because markets have supposedly changed, it is time for you to run, period. Number 10. Leverage is dangerous. This one is contentious. Yes, a major factor of retail traders' failure is undercapitalization. There's no question about it, which is the same as saying that they don't have enough money in their bankroll for the maximum risk that they are taking. But leverage is the red herring in a trading solvency equation that has a lot more moving parts. Unlike what regulators will have you believe, lowering your leverage will not protect you, and it sure will not save the outcome of your trading account either. It will merely delay an identical outcome. So when the CFTC went ahead and destroyed forex trading for US clients by hammering the maximum amount of leverage to be taken, they did not make your trading any safer in the slightest. What they achieved instead is that they removed a way for you to dial your risk in or out without cutting your ultimate risk of ruin. Actual risk of ruin is a combination of leverage, position size, tick value, expected maximum drawdown, and of course the overall expectancy of your strategy. Combining these 5 components will decide whether you go bust or not. Get one of these wrong and you will go bust. See, leverage is just a piece in the puzzle. And one very pernicious effect is that by focusing on leverage as the single culprit for too much risk, is that once it is low enough as was mandated by regulators, you tend to forget about all of these other factors that can be just as dangerous, if not more. And in doing so, what happens? Well, you get a false sense of safety that will lead you to allow yourself to become reckless with other risk management parameters and overall system design. Simply because, well, after all, leverage is low, right? Well, a low leverage will not save a failing strategy from ruining you. Everything else being equal, it will only take longer to get there. Number 11. Let your profits run. Here comes one of the hallmarks of trading myth, in relation to your risk-reward myth number 5 actually. You know, the kind of foolproof trading advice that sounds like common sense around a beer with friends, but that will wreck your account as soon as you get home trading. Kind of like the you can go broke taking profits, or you don't lose if you don't sell trading advice of the world. Great. Okay, so what is wrong with letting your profits run? The problem here is that you apply a blanket statement to a notion that is relative. Namely, the relevance of whether or not you should let your profits run depends on many properties of your underlying, of which volatility and the type of price motion will have the greatest incidence. Assuming that these two remain unchanged, you're also facing the issue of probabilistic proportionality when insisting that letting your profits run is always a great idea, meaning that it is not uncommon for your probability of winning to fall in commensurate proportions, if not more, as you seek to let your profits run, thereby keeping your expectancy identical, if not decreasing. In other words, there is no magically increasing your profitability by simply letting your profits run. So be very careful of these catch-all statements. Once again, you need to test your preconceived ideas, especially when you borrow them from unproven traders from trading forums. Okay, last one. Here's myth number 12, the big one, that you should always use stop losses. And I can hear most of you scream off the top of your lungs, "What? You should always use a stop loss. How is that a myth?" Yes, people, it is a myth, and probably the most widespread trading myth out there. Just make this social experiment. Go ahead, ask 100 traders whether stop losses should be mandatory when trading. I absolutely guarantee you that you will get less of a consensus about the color of the sky on a cloudless sunny day. And yet, this belief has killed more trading accounts than anyone will care to admit, especially in Forex. Now, I know what most of you are thinking. This guy is full of it. Yet, you don't have a long-standing successful trading track record to back up what you're saying. And I do. So what gives? Well, let me let you in on a few nuggets here. First of all, most of the time, stop losses will hurt the risk-adjusted performance of a trading system. Ask any quantitative system designer. They know it like their own name. Second, insisting that using stop losses should be mandatory starts from a fundamentally flawed belief, which is that risk management can only be enforced with stop losses. This is fundamentally wrong. Saying that stop losses should really be used does not imply that risk should be left unchecked. This is not what I'm saying. Quite the contrary, actually. It means that because risk should be harnessed absolutely, smarter and more efficient ways to manage it should be used other than brute force stop losses. But most traders don't know any better than just using these vulnerable orders, so they do it anyway with a quasi-religious fervor. Truth be told, there are a ton of different ways to manage risk, and on top of that, some markets are just not suited for using stop orders for both intrinsic and industry-related reasons. But I've already said too much. This opens a longer discussion for another day. And no, I am not alluding to mental stops either, which are even worse actually. So here we are. These were the top 12 trading myths that you need to do away with if you want to advance your game. There cannot be any constructive trading education possible before we clean up your trading frame of reference from these harmful beliefs. And that is what we've been doing here since course number 1, cleaning your own mental software in order to prep your mind to take in the foundational building blocks of trading success. Next up will be a special edition addressing those trading myths pertaining specifically to Forex. So stay tuned. Keep watching these courses in their order of release and put in the work. There is no instant gratification in trading, but there is a solution and I will do my best to get you there. Talk soon, traders.